Hello, welcome to this webinar where we're going to discuss the SMEs funding problems with an awareness of capital raising opportunities. I'm Peter Towers, Managing Director of ESS BIZTOOLS. Thank you for joining us for this webinar. If you're watching this webinar at a time more convenient for you and you have any questions or would like to get some further information about the services provided by ESS BIZTOOLS to assist accountants, bookkeepers, and business advisors to supply financial and commercial advisory services to SMEs, please contact me and we'll have a discussion and we'll give you further details. So what are the capital raising opportunities for SMEs? For many years, all we had was Section 708 of the Corporations Act. And it served us fairly well, but it was difficult. I was a business advisor to the federal government's COMET program, Commercialising Emerging Technology. There were 12 business advisors that serviced Australia, and we were looking for people who had invented or developed new ideas, new products, new services that needed to be brought into an investment ready status to be able to raise capital. And all we had was Section 708 of the Corporations Act, which does have some limitations, which I'll discuss with you later in this webinar. But the point I'm making is it did help raise a lot of money around Australia for a lot of innovative businesses. So it's still there. Don't forget it. Section 708 is still there. But 8 years ago, under the Malcolm Turnbull Liberal National Party government, major breakthroughs were achieved when the early stage innovation company capital raising legislation and the crowdsourced funding equity raising legislation were introduced to federal parliament. Now, they were introduced at the same time, so they were treated as running mates. Unfortunately, they got separated along the way. And early stage innovation company process become law about 8 months before crowdsourced funding equity raising did. It's also interesting to note what part of the legislation these two new types of companies were created from. The early stage innovation company is amendments within the Taxation Act. So that's interesting, because a lot of accountants tell me they only specialise in the Tax Act. Yet when I ask them about early stage innovation company, they tell me they've never heard of it. Well, it's part of the Tax Act. And crowdsourced funding equity raising was created by amendments to the Corporations Act. So that's where it's embedded in the legislation. And we're going to talk more about those three capital raising opportunities a little bit later on. So let's look at Section 708 of the Corporations Act. And prior to the Unified Corporations Act, which was introduced around 2001, each state had their own company law, and a similar section to what is now called 708 was embedded in the state legislation. So it's been around for around 40 years. Section 708, but it's been a different acts of parliament. Companies can seek to raise capital through private offers using Section 708. A private company can raise up to $2 million in 12 months, but is limited to 20 investors. And bear in mind that a private company can only have a maximum of 50 shareholders, so they don't have the opportunity of using Section 708 for very long. Once they get to the 50 shareholders, that's it. They've then got to move on to becoming an unlisted public company if they want to continue to raise capital. As a general rule in the Corporations Act, if the entity is a public company offering securities for sale, then the company must provide a disclosure document to potential investors. So that's a prospectus or some other document which is submitted to the Australian Security Investment Commission for approval prior to release. That's what I've just said. Offers do not have to have a disclosure document if they are covered by Section 708 of the Corporations Act. And that's commonly known as the 2012 rule. So you can have 20 investors in a 12-month period. You don't need to have a disclosure document. There is a breach of the 20 investor ceiling if it results in the number of people to whom securities of the company have been issued exceed 20 in any 12-month period. So if you're advising a company that's already issued some shares, bear in mind if that's within 12 months of when this next issue is going to be considered, that number of shares, let's say it was 3, has already been allocated out of the 20. So there's only 17 remaining shareholders that could be brought into the company. You just need to watch the numbers because ASIC will monitor it. Now, an offer made under Section 708 must be a personal offer. A personal offer is one that is accepted by the person to whom it is made. So it's not a situation of going onto the internet and in social media saying XYZ Proprietary Limited is having a share offer and would like to talk to anyone that's interested in being a shareholder. That's not a personal offer. And is made to a person who is likely to be interested in the offer, having regard to previous contact between the person making the offer and that person. Now, that could have been in day-to-day business operations. It might be, though, that you play golf with that person. One of the directors plays golf with those in their local golf club, and they may have had a discussion about the company a couple of times. Some professional or other connection between the person making the offer and that person. So the company's solicitor or the company's patent attorney are people who have got professional connection between a company director and that person. So you could send the proposal or the documentation that's been prepared to them. And statements or actions by the person that indicate they are interested in offers of that kind. So that basically relates that a member of the public has contacted a director or the manager of the business and said, I'm very interested in your organisation. If you're ever looking to raise some capital, can you bear that in mind that I'm interested in having a look at your documentation? Those types of conversations. So it's not clear cut, and the directors would need to clearly identify for each shareholder what section of Section B that they fell under, so that if you ever got an inquiry from ASIC, you have an answer. Now, marketing or advertising of the offer under Section 708 is prohibited. You just cannot do it. There's no going onto the internet and promoting. So the documentation for investors, now this is not covered by the legislation, but we've included it so that if you're discussing these issues with your clients, you can clearly indicate to them. Sound corporate governance indicates that the following documents should be submitted to potential investors. A business plan identifying the company's vision and identify what the capital raise is going to be used for. That's very important. And for capital raising that has to have a disclosure document prepared, that information is one of the key requirements. I can't see any reason why someone trying to raise capital under Section 708 would not also provide it. Predictive accounting reports. Now, this is the financial interpretation of the business plan. The budgets, the key driver accounts, that's for inventory, debtors, creditors, capital expenditure, research and development, export market development planning expenditure. Anything that's a sizable item that needs review to see how much money's been spent there, because these items can get hidden in the profit and loss accounts and cash flow forecasts when you do budgets. I think it's a good idea to highlight them so that the leadership team can have a good close look at them. And then we would have the cash flow forecast and the projected balance sheets. And the projected balance sheet's a great document. It enables you to be the storyteller, to be able to say to your client, well, if we achieve these objectives that we laid out in the business plan that we've then reflected in the budgets, this is what this company should look like in 3 years' time. And the directors can then discuss that with the leadership team and decide whether that's the position they want to be in. They might have thought they'd be in a better position than that. Well, we can then work on it, can't we? An evaluation of the company. I think this is very important because there's got to be a determination for the injection of $2 million, say, into this business. What percentage of the shares are those new investors going to receive? So this gets back to who are already the shareholders. What's the business worth before the $2 million is contributed? They should have shares to reflect that. And then we've got the new shareholders coming in that could be contributing $2 million. But they may only be contributing $50,000, of course, or any other figure up to $2 million. But evaluation of the company will help in those negotiations. A lot of these companies are basically in the startup stage, so the normal way to prepare evaluation is to look at a critical review of the budget forecast and what has happened in the past, and try to prepare a present value forecast capitalized at a realistic price earnings ratio. And all that is difficult and needs to be examined and comparisons made to others. And obviously, you cannot expect to utilize the best price earnings ratio that you can find based on stock exchange listed companies, because they've already achieved a lot of things. A startup type business, which is most companies under Section 708, will probably not have a very outstanding price earnings ratio that you could realistically use. So that's Section 708 of the Corporations Act. It's got some limitations, but it's still very appropriate. And in fact, it's very appropriate to the next item we're going to, because early stage innovation company is not a separate corporate registration. All it is a company achieves the status of being an early stage innovation company through a process, which I'm going to take you through now. And if a company achieves that status, which in one set of tests under the principles test has to be certified by the Australian Taxation Office and Oz Industry, who are the two government departments involved in this, and they issue a certificate. But if the company is able to self-assess under the gateway test and passes the requirements of the gateway test, and I'll share them with you shortly, the company is able to make presentations to investors and indicate to them that the company has achieved the status. And the status is very important because the legislation has got a fantastic, unique situation, because investors in a company deemed to be an early stage innovation company obtain a payment from the Australian government. In other words, there's an incentive for people to invest in these sorts of companies, because the Australian government at the time, under Malcolm Turnbull, wanted to try to encourage investors to invest in smart, young Australian companies. And Mr. Turnbull knew a fair bit about that from all reports that I've read. He'd been an early investor in a couple of companies that achieved great results. So he had an understanding of the capital raising frustrations that many innovative companies have. So that's the reason this legislation's there. But they're basically using a company that's been formed and qualifies under Section 708. So the company is required to qualify under the legislation, which primarily relates to the company's age. There's one group that is up to 3 years of age since the company was incorporated, and there is another opportunity, not as wide, but for companies up to 6 years of age to qualify. Any older, they don't qualify. So this is for young companies, not necessarily young executives, I might add, but young companies. The next part of the initial requirement is the company's turnover in the income year before the current year. Basically has to be less than $200,000, not including any grant funds received from the Accelerating Commercialisation Grant. So under $200,000. So we've got a company that's not really hitting its straps yet as far as earning income. And the third requirement is the company's expenditure in the income year before the current year is required to be under $1 million. So they're the requirements. Basically under 3 years, but perhaps in some cases can be up to 6 years of age. Income under $200,000, not including any grant funds from the Accelerating Commercialisation Grant. And expenditure in the previous financial year under $1 million. Can you think of any clients you've got like that? And these companies need to have been involved in research and development or innovative activities or planning to go there. They've done a lot of thinking, a lot of planning, a lot of documentation. So the first, once you go through the age, the turnover, and the income, and we say, well, we've passed those. And bear in mind that all of that documentation will be checked by the tax office. We then go through that the company can elect to do the gateway test. Now, they don't have to all do the gateway test. Some could go straight to the principles test, which I'll share with you shortly. So the gateway test is self-assessed. When finalised, the directors can communicate with the potential investors who will probably require access to the documentation that supports the company's belief that the company is self-qualified as an early stage innovation company. Now, I'm going to show you the due diligence checklist that we use within ESS BIZTOOLS on this, but the company will receive points if it's achieved various items, and they need to accumulate more than 100 points. If they can accumulate more than 100 points and then have the documents to submit to potential investors, they have achieved that part of it. Obviously, the documentation is very important. It can be called upon at any time by the tax office or Oz Industry as part of this process. The principles test, the company needs to apply to the taxation office for a ruling as to the company's eligibility. To achieve this status, the company has to answer 5 questions, and I'll show you those 5 questions when we go onto our website. The tax office issue a certificate to the company, in this case, if they're qualifying under the principles test, to say the tax office is satisfied that the company is eligible for the status of an early stage innovation company. Now, the benefit to investors, because this is really the key to this legislation, there are no direct benefits for the company other than the company gets investment dollars from a group of shareholders. But the benefit for investors is that an investor receives 20% of their investment in the company as a tax rebate off their tax bill. And for a sophisticated investor, the maximum tax rebate they can earn is $200,000. That's 20% of their investment. So that's calculated on $1 million. They can invest more than $1 million, but the cap is $200,000. For a retail investor, the cap is $10,000, 20% of the investment, because the legislation restricts a retail investor to only being able to invest in a 12-month period a maximum of $50,000 into a company that aspires to be a early stage innovation company. But there's more. Eligible investors are not liable for the payment of the capital gains tax on the sale of the shares that were allocated as part of this early stage innovation company assessment process if they hold those shares for longer than 12 months and less than 10 years. There's no capital gains tax. So it doesn't matter if that shareholder paid $5,000 for those original shares and ultimately they're worth $500,000, that gain is tax-free. If they hold the shares for longer than 10 years, the company can be revalued at the end of 10 years, and the shareholder then has a new cost base for their shares, and ultimately they will pay capital gains tax, but at a reduced amount because they're working off a reduced cost base. So that's how the early stage innovation company works. I'm going to show you on our website when we go there the detailed intricacies of how the early stage innovation company process works, but I hope that's given you some ideas. So the legislation could also, of course, benefit investors. If you've got clients who are interested in investing in young Australian companies, it might be their superannuation fund or somewhere, they could be interested in this opportunity. But the main group, of course, will be your clients. They will still need business plans, the predictive accounting reports, an understanding of the process. So you will need to have mentored them in that. I think a good knowledge of corporate governance, because the investors may require one or two people to be appointed to the board of directors. And you wouldn't want your clients to be embarrassed because they didn't really understand corporate law. They've never worried about it in the past. Suddenly they got a very experienced director or a lawyer or someone like that sitting on the board. They might say, oh, we're a bit out of our depth here. Well, you can help them by mentoring them beforehand. And down the track, of course, there could be the potential for your firm to be appointed the virtual chief financial officer of this company as they grow and they get investment money in, because investors obviously think they're going somewhere. That's why they're investing in them. I now want to turn to crowdsourced funding equity raising. This was the stablemate of early stage innovation companies, as I said before. It's different. It's available to an Australian registered public company or an unlisted public company. Now, when the legislation was first introduced, it was only to be for unlisted public companies. But the marketplace didn't like that. And the government produced amendments to the legislation about 10 months after the original legislation was introduced. So we had this bit of a stalemate period. There were about 6 or 7 companies went through the process as unlisted public companies in that initial stage. And then there was this rather long lull in proceedings as the legislation had to get changed and then reacted and then had to get proclaimed and signed off and all that. It caused a bit of a hiccup in the overall process. So it's now available to a private company and an unlisted public company, subject to the next couple of clauses. The company must have an international turnover of less than 25 million Australian dollars in the previous financial year. The 25 million in the previous financial year is the upper limit, the turnover. And the company must have a gross value of international assets of less than $25 million Australian. And the company must not be listed on a stock exchange anywhere in the world. Once the company is approved to be a crowdsourced funding equity raising company, there must be at least 2 directors based in Australia. So normally a private company in Australia only needs 1 director, if you're going to be a crowdsourced funding equity raising company, you must have 2 directors that are based in Australia. So if there's a desire to appoint a director from overseas, well, there must be an extra director in Australia. So on that basis, the company would have 3 directors. Now let's look at the intermediary. This was a new concept introduced in this legislation. The crowdsourced funding legislation established the position of a crowdsourced funding intermediary. Now, the intermediaries are businesses that hold Australian financial services licenses. When the legislation was first introduced, the Australian Security Investment Commission advertised for businesses with Australian financial services licenses to apply. I understand that about 380 firms applied for that registration. Initially, 6 businesses were awarded the intermediaries licenses, and then over a period of time, I understand it's increased to around 16. Unfortunately, ASIC do not publish a list of who the intermediaries are. It's a bit of a search effort you've got to go on with to find out who's an intermediary. So the crowdsourced funding intermediary has got a lot of power and responsibilities. Mr. Morrison was the treasurer that introduced this legislation, and when he did so, he indicated that the intermediary wears 2 hats. One hat is that they're the representative of ASIC, Australian Security Investment Commission, but the other hat is that they are a broker assisting in the company to raise capital, and that they have made communications with potential investors. So they're in the marketplace. One of the intermediaries has told me they got over 50,000 potential investors on their database. Others claim they got 25,000. So they've built up big databases of potential investors, and they are in continual contact with them to see whether people are interested in more detail. There is a prohibition on advertising and promoting for these unlisted companies to raise money, but once the crowdsourced funding intermediary has indicated they are satisfied that a particular company is eligible to proceed with a crowdsourced funding equity raising process, they will then authorise marketing and advertising to be conducted. So this is part of the power of the intermediary. The intermediary has to check a lot of documentation before then, but once they're satisfied, they issue a letter and the company can help market and promote. Now, the capital raising can be up to $5 million, so it's not a small amount. In fact, over the 8 years in between, as far as I know, only 2 companies have raised the full $5 million. A couple raised it over a couple of years, because at the end of the first year, if the company wants to go back and apply to be re-accredited again as a crowdsourced funding company, so they still have to be under the 25 million turnover, gross assets, pardon me, under 25 million. They could be given the mandate to proceed again. They could raise further money. And what the company is issuing is ordinary shares. So it's not loans, there's no interest, there's no capital repayments, they're ordinary shares in the company. There's a requirement for a crowdsourced funding offer document to be prepared. And whilst I've said in the slide, it's the responsibility of the directors, I think the actual preparation would be undertaken by you if you're the accountant for this company. It's a detailed document that has to be completed, and it has to be submitted to the intermediary for review, and the intermediary will ask questions, and ultimately, hopefully, they will approve. So there's some key information in this offer document. And there's 4 major sections. Number 1 is risk warnings. Now, the risk warnings is stipulated in the legislation. You cannot vary it. If you try to vary it, the intermediary will not approve the document. Section 2 is information about the company. And that information includes a lot of detail about the directors and the management team of the company. And if a director or a management team members ever had a problem with Australian Security Investment Commission or with a court over anything to do with being a company director or an officer of a company, that has to be disclosed in the document. So you need to make sure that your clients understand that. And section 3 is information required to be lodged in the crowdsourced funding offer document. So the legislation spells out various information that has to be lodged. And section 4 is information about investors' rights. A retail investor has got a period of time that they can change their mind and they can ask for their money back. That all has to be specified in the document. Now, all of the capital raising must be processed by the appointed crowdsourced funding intermediaries platform, their website. So the directors can't go around and talk to various people and get the share application form completed and then bring it back to the office and say, I've just raised $10,000, here it is. That is not the way it works. The investor must go onto the intermediaries platform, their website. And one of the key reasons for that is that there is a document that the investor has to sign with the intermediary indicating that they have read the investment warning and that they understand it. So the government wanted to make it very clear to investors that there are risks in this type of investment and everyone's got to go through the intermediaries platform. So the example I've always used, even though the director's got a favourite aunt who's getting on a bit in years and she wants to invest $100 in the company of her nephew, the director cannot accept that $100 for the issue of shares in the company. He must say to his aunt, you need to get onto the internet, and maybe the director needs to facilitate that to happen if the aunt doesn't understand how to do that. But she has got to be on the internet to confirm that she has read the documentation and she's happy to invest. The company can set a minimum and maximum amount of capital to raise, and this would be in the offer document that's gone to the intermediary for approval. So the company could say, well, our minimum capital raise is $1 million, but our maximum capital raise is $1.6 million. Now, if the company nominates a maximum amount, it's then got to detail quite separately what it's going to do with that extra capital. In this case, in my example, $600,000. What's it going to do with that money? And the legislation does not enable companies just to get hold of capital and put it into the bank account. The government wanted this money invested, wanted it to be put to work, wanted to create employment, wanted it to be generating income so that ultimately the shareholders, the new shareholders and the current shareholders could receive dividends from the activities. The maximum capital raising period is 90 days. That's the maximum. Can't be extended after 90 days. So if the capital is not raised within the 90-day period or the shorter time period set by the directors, so the directors can say to the intermediary, we're quite happy with a 20-day period. We don't get the money by then, well, we won't worry about it. And that's the reality, because if they directors set a lesser period than 90 days, let's say to raise $1 million has been the minimum, and at that stage only $800,000 has been raised, the intermediary has to refund the full $800,000 back to those individual shareholders. So my recommendation is always encourage clients to say that the period is for 90 days, so you've taken the maximum. It doesn't matter if the minimum amount is raised in 5 days, which in some instances it is. If they've got a maximum amount nominated, which on the example I gave you before, yes, that was another $600,000, the process would then continue. The $1 million first lot's been raised, we're now raising the second. Again, the period of time that's been stipulated needs to be closely looked at. I'd be having 90 days every time, so that you are giving yourself the maximum opportunity to raise capital, because there can be all sorts of things go on in the community. There could be a major natural disaster somewhere that affects everyone, and people are just too busy. And if your clients put a very short period of time, 10 days, 20 days, which I've seen people do, and I shake my head every time and say, that is dangerous. Something could go wrong. And then you've missed out. And then you've got to go back and start the process right over again. So about $440 million has been raised by crowdsourced funding, equity raising over the last 8 years. Unfortunately, I can't find out how much has been raised as an early stage innovation company. Government doesn't seem to publish that information, which is a bit unfortunate. And I think they should. So if you've got any way of stirring the government up a bit to make sure that ASIC or the tax office, probably the tax office, publishes that figure, that'd be very interesting for us to know. Now, $440 million is not a lot of money, but at least those investors have seen some benefits in this sort of company capital raising. I've seen some figures which indicate that around 72% of the investors are retail investors and 28% are sophisticated investors on the 8-year historical average. I think accountants can play a key role in an awareness of crowdsourced funding, equity raising, and early stage innovation company, but primarily the crowdsourced funding, equity raising, where we've got the intermediaries in place. There are at least 16 firms appointed. On my observation, 3 of the intermediaries are fairly busy. One in particular, Birchall in Melbourne. But there's another 13 firms, and they seem to have drifted away from involvement in crowdsourced funding, equity raising. Why? They're not getting enough applications. They're not getting enough deal flow. Who can help them get deal flow? You, accountants. That's one of the reasons I wrote the material on crowdsourced funding, equity raising. I was excited when I first got involved in this. I thought it was a bit dry, but over times, the ASIC and the intermediaries have made it a bit more interesting. Some of the websites that have been put together for various companies are great, and a bit more liveliness than what I thought would be when I read the print of the legislation to start with. But they're not getting enough deal flow, because these companies need to have a business plan, the predictive accounting reports, have a vision, understand what this legislation's all about, understand some corporate governance. Obviously, they've got to prepare the offer document. So there's a whole process. You're the key professional that can help your clients get this process put together if they need to raise capital. But bear in mind what I've got there on the sides. There's no interest payable. There's no capital repayment. Sure, there's an allocation of shares, but this is all about wealth creation. That extra money coming into the company should help the company to grow. The company's got to meet market expectations. One of the intermediaries publishes an annual report and indicates that they only ultimately support about 3% of the people who make applications to them. 3%. And over the years, I've interviewed people from that particular intermediary, and they say, well, people come into us and have got no idea what this is all about. Or we ask them for a business plan and they've never done one. Budgets and cash flows are something that someone wrote on the back of a sheet of paper and handed it over. So there's a lack of understanding how this process works. But they might have a good business. What they need is real commitment by key advisors like you. I think we need to be talking more and more about the capital raising opportunities for SMEs. And in fact, I want to now just refer to some information that's been published by Scott Mack, the SME Growth Index, produced in October 2024, because this indicated that SMEs are looking for capital for their businesses, more and more of them. And I'm just going to read a couple of the key points here. SMEs seeking capital. 94% SMEs require new business funding in the next 6 months. Now, I must admit, when I've read this, and Scott Pack have done a great job on all this, but they are a broker helping people raise loan funds. And a lot of that is now coming from being able to just go straight onto the internet and arrange the funding. So 48% of SMEs expressed a preference for a straight through online only applications. You won't be able to do crowdsourced funding or early stage innovation company in that way. But this report is saying 94% of SMEs across the board, 94% of SMEs surveyed foresaw a need for new borrowings. The strongest response come from SMEs expecting revenue growth, with just 3% of this category ruling out the need for business funding. So these businesses are businesses that are creating some activity. Now, if they want to borrow the money on the basis they conduct the application and the loan process over the internet, that's their right, of course. But I think you should be also talking to them about the other opportunities. They can raise capital, share capital. They might not have thought of this. They might not realize they can really do this. They can do it. It's not a loan, so they're not paying the interest rates, and they definitely do not have to repay a loan at the end of the loan period. It's worth talking to your clients about it, as I see it. So we're now going to go onto our website and have a quick look at a couple of these issues so that you can have an idea of where we're getting these items from. So I'll just click across to our website. I'm now on the website, and we'll go in the order I made the presentation. So we're going to go to, incidentally, ESS BIZTOOLS has got 4 product packages. We start off with advisory intro. That's for someone that's inexperienced in offering advisory services, especially financial and commercial advice. We then can move into the starter package where everything rolls over, then to the advanced package, it all rolls over. Then we go to the financial forecasting package. And this gives you an idea of what's in the financial forecasting package. There's a whole range of material. And if we click on Get Content, we get a great list of forms and papers and flow charts and everything else that relate to that. So what I want to do now, I'm in the left-hand column here on our website. I've got details of the major product packages within ESS BIZTOOLS. I'm just going to click on early stage innovation company. And we are then going to download the content. So this is a list of the content within the early stage innovation company. You can see all these BASs. That stands for Business Advisory Services Form. There's a form for a whole range of activities, because obviously the company is not only getting itself assessed as to whether it's an early stage innovation company, it's also got to have information that would encourage an investor to invest in them. The form I want to show you is the so that form is now on your screen. It's the Business Advisory Services Early Stage Innovation Company form. So we're going back to the beginning. I'll just wind it back up. And you remember I talked to you about 3 years and 6 years and $1 million in expenditure and $200,000 in income. We answer those questions there, and we go through what's called the test time determinations as to whether the company is going to be approved under 3 years of age, whether it's going to be approved under 6 years of age. And there was another category that I didn't mention, whether they've been registered on the Australian Business Register in the last 3 years. It was another category. And we've gone through that, and we've got a company that looks like it fills the requirements. We can then go into the gateway test. Now, the gateway test, I told you there's 8 questions, and there's points allocated for various questions, and they need to accumulate 100 points. If they can do that and they've got all the supporting evidence, they have self-assessed as a early stage innovation company and can then talk to investors and show them the documentation. So within ESS BIZTOOLS, we've produced forms for each process so that the directors of your client company can communicate with potential investors. So the first lot of questions relate to, did at least 50% of the company's total expenditure for the previous income year, was it expenditure that the company can notionally deduct for that income year for research and development? And was it more than 50% and of the expenditure? Now, if it was more than 50%, they earn 75 points. That's the detail there. If it was between 15% and 50%, they earn 50 points. So if they've undertaken research and development that's been submitted through to the tax office and Oz Industry, because you can go through Oz Industry as well for research and development, so that it's gone through that process, they're well underway on the gateway test. Has the company received an accelerating commercialization grant? Remember, we talked about that before. And if so, they earn 75 points. So if they've been in the accelerating commercialization grant and they've done more than 50% of their expenditure on research and development, they've got 150 points. So they're well and truly self-qualified. Has the company completed or undertaken an accelerator program? If it has, they earn 50 points for that. And what we've got in here is what you would be typing in is all the details that are ultimately going to appear in the supporting documentation. Has at least $50,000 been paid for an equity interest from people acting at arm's length? So that's people that have already paid up to $50,000, at least $50,000 aggregating. So there might be 5 of them have paid $10,000 each. That's the $50,000. So what that's showing is the company's got some support in the marketplace. So we detail who they are, what the shares were, the date of issue, because all this could be checked by audit, and they earn 50 points for that. Has the company any rights under a Commonwealth law for a patentee or a licensee of a standard patent? or a plant breeder's right. And if they've got all that and they specify that, they earn 50 points. Or has the company got any patents or licenses for an innovation patent or a registered design? If so, they earn 25 points for that when we go through and fill in the details. And if they've entered into a written agreement with an institution that's listed under the Education Funding Act or the Research and Development Act, they specify those details, they earn 25 points. So if you were using the form, and you would have this obviously if you were one of our subscribers, it's totaled up how many points you've allocated. If it exceeds 100, congratulations, your client is self-assessed under the early stage innovation company. Now, all's not lost. If you only come in at 80 points there, don't let your client get too depressed, because then you can move on to the principles test. Now, the principles test is primarily there for very new companies. A lot of the work may have been done by a private individual, and then they got told if they really want to get taxation benefits, they've got to form a company. So they formed a company, but they've done all the research as an individual. So they haven't got any of that track record to answer the research and development question, because that is based on the company having lodged that information in their tax return. So they have to answer some questions. Now, then I stress to people, these are not yes/no answers. I've done a lot of work over the years involving Oz Industry. I think I mentioned before I was a special business advisor for the COMET program, Commercialising Emerging Technology. We were retained, but we're all private enterprise people. We were retained by Oz Industry. So I understand how Oz Industry go about a lot of these things. These questions are very similar to what Oz Industry ask in some of the grants that they administer. They're looking for more than a yes or a no. They're looking for more than one or two lines. I think that they're looking for at least an A4 page. Now, I've acted for a number of people going through this process under the principles test. They've all been successful. And one of them actually got an external consultant to prepare the answers to these questions, but retained me to put the rest of it together. And that consultant produced 28 pages. So I'm not saying you've got to produce 28 pages, but I'll give you an idea. So the first question is the company genuinely focused on developing for commercialization one or more new or significantly improved products? Put in the details. Does the business relating to those products have a high growth potential? Okay, so we're looking for more than a yes, obviously. Can the company demonstrate that it has the potential to be able to successfully scale that business, really grow it up? Okay, we'll have to give them answers to that. Can the company demonstrate that it has the potential to be able to address a broader than local market? Okay. And can the company demonstrate that there's the potential to be able to have a competitive advantage? So they go through and answer these questions, and we're then able to analyze them and submit. That's all then got to be submitted to the ATO. We have forms for each of those questions that you would complete, so that you are making sure that every bit of information that the ATO require is submitted to them. I'm told by the ATO they take about 6 weeks, because they share that information with Oz Industry, and they decide whether they're going to award a certificate to say this company has qualified as a early stage innovation company. So hopefully that gives you a good understanding of this process. I'm now going to go to our special offer. That is very important, of course. As part of the Biz Aid by ESS BizTools, our special offer is for the early stage innovation company. We're offering a 50% discount. So for 12 months, 24/7 access, you can process as many companies as you like. It's now going to cost you $750, including GST. And If you're interested in the crowdsourced funding equity raising company, it's the same deal. 50% upfront discount, 24/7, 12-month subscription, $750, including GST. Now, if you're ready to take action, and I hope that you've got some interest, please go to our website, www.essbiztools.com.au, click on packages and pricing, and then click on individual products. And you can then complete the subscription order form. It's as simple as that. And if you need more information, please send me an email, peter@essbiztools.com.au, and we'll respond to your questions. I'll make sure you get an answer back. Or you can telephone me, 0747241118. So thank you for your interest in our BizAid program, which is really trying to encourage accountants, bookkeepers, business advisors to subscribe for product packages that you could immediately use with your clients. Because out there in SME land, there's a lot of problems. And some of these products that we've talked about today, Section 708 of the Corporations Act, early stage innovation company, and crowdsourced funding equity raising could be just what your client needs. Admittedly, they've got to have a vision. They've got to have something churning away in their stomach that they want to achieve in their business. They've got to be enthusiastic. They've got to have all those attributes, but this may be the answer for them. They could look at borrowing money, but borrowing money brings with it the obligation to make interest payments, and the interest payments are rather high. And they also ultimately have to repay that loan. Now, admittedly, a lot of the loans that are currently available do not involve security other than a personal guarantee. But this is giving the opportunity that if they've got what appears to be a reasonable business, and especially if it can be all packaged together as to where they're headed, they could potentially raise capital from the public. Won't be everyone's cup of tea, but I think you owe it to your clients to communicate it to them. So good luck with all this. I hope it all works out for you. Merry Christmas and a fantastic 2025. Goodbye.